So this week we're going to do a lot of retreading of last week and a continuation. So I just want to lay out levels, what I'm seeing, why we're making some of the decisions that we're making. And I'm going to start off right now with this right here. And this is clearly a three-wave move off this low. 1, 2, 3. And just follow me here. Every time we've seen a three-wave move off the low in this bear market, 1, 2, 3. 1, 2, 3, 1, 2, 3, it led to lower lows. I'm not saying that's going to happen right now, but the fact that this move off the low is three waves is still a warning sign. It doesn't mean this isn't the low, but what it means is pretty high odds we're going to have a deep retrace once this move ends. And you could say to me, well, look, we made new highs. We gapped up to new highs right here, and that's quite bullish. But still, we did that back in March. Gapped up, new highs, then failure. This to me looks like, within trends, especially C waves and third waves, which this really is right here, one or the other. You typically have three gaps. You have your initiation gap, then your continuation gap right here. See that right there? It's usually in the middle of the move. And then your exhaustion gap. And I'm willing to bet that's what's going on right here. So I wouldn't be shocked if we start to see a bit of a pullback begin, maybe not this week, but in the next week. And so just more confirmation of this is, for one, the RSI still can't break out of the bear market resistance. It's trying to, but it's still below that bear market resistance right there. And you have the composite index, which is just the RSI with the momentum factor, so that you can identify these kind of hidden divergences, because the RSI is not very good at giving divergences before like a change in trend. And you can see pretty clearly three waves down with three waves up. And this last wave is failing underneath these moving averages. So I think we're probably pretty close to seeing some kind of a pullback. One of the reasons why we've been raising some cash is because, for a few reasons, we feel like we can get better prices in some of these positions, but there's still uncertainty on whether this is the bottom or not. And I'd rather go heavy and into, potentially margin when we got that confirmation that that's what's going on, and we can get into that third wave trend of a bigger move. So moving forward, this is the grid I believe we're working off of. These are Fibonacci confluence zones. Very strong reactions to these levels. Very important levels. When we broke above this 4,170, what's next is 4,235. I wouldn't be shocked if we hit that on weakening momentum. So these are the levels I'd be monitoring and tracking. And if we were to identify what this three-wave structure is, like I said, more times than not, when you get three waves, it's a corrective structure within a bigger trend. So the bigger trend is the downtrend, right? So this would be a bigger, this would be a corrective move in a bigger trend. The one scenario where this could be a developing new uptrend would be what we call a leading diagonal, where you get five waves off the low in this overlapping fashion. Now, leading diagonals are rare. They do happen. They're not super rare to where you want to ignore it, but the rule is you don't trust it until you get five waves. All right. And right now we have three. So let me show you what this would look like. Let's see here. Yeah. So we have the blue and the red. So the blue is the leading diagonal. We have one wave, two. This would be 3, 4, and then 5. So what we need to see happen in the coming pullback is it needs to hold, 40-20 to 39-40. And then turn back up in a three-wave move. And if we can do that, if we can pull back and hold this leveling at three waves to a new high or potentially a double top, then that's going to support that this is actually somewhat of a meaningful low. There's still more work to be done, but that would be a very positive sign. The other alternative is that whenever we get this pullback coming, that we break below 39.40, probably bottom somewhere in 39, maybe a little lower, and then we get five waves up off that low. Now that will signal that this is likely a very large degree B wave, and that the move we had down right here was the large degree A wave, and what would follow would be a large degree C wave. Now, what that means in terms of, the narrative that would cause that, usually in these bear markets, most bear markets, if you look back in history, they're just like 20 to 30% drops, and then we take off, right? And these bigger, like longer, drawn out ones, like, say 2000 and 2008, what typically happens is the first move down breaks something, and we don't find out what that is until the B wave tops and something breaks and the C wave just takes us down. That's really what happened in 2007, 2008, and also in 2000. But anyway, so that's what it would be, and I wouldn't take that lightly, because when you start seeing central banks globally raising rates as aggressively as we just saw, and 75 basis point raises is not common, and I think we had two of those. So, the odds that something was broken, it's more than just a coin toss, I would say. So that's probably what it would be, is this B wave would play out until we find out something was broken, and then we see the C wave down. But I do think that we will get that C wave move up. And if you think this is going to create FOMO, if we get this, it'll create a lot of FOMO. It'll probably break through the 200-day. It'll probably break through the bear market trend line. But this structure will be the biggest warning. If we get that A, B, C, we'll know when we start getting up into this, fifth wave up here, start hedging, start raising cash. Okay, so that's the game plan right now. The odds that we break down straight to new lows, I think it's pretty low right now. If we break below 39.40, this blue is coming off the board. My alternative count will be going to new lows, and I'll tell you what that looks like. But these are the two most likely scenarios I see playing out right now. The other thing is the time factors. So these have been, eerily accurate. They continue to be. We were looking for an inflection point and got it here in late July. And what that inflection point was, that this is a third wave move. We got confirmation that this is a third wave or a C wave, and the trend changed, and it confirmed that we're in a either the low is in, or we're in a larger B wave, that we want to actually take our hedges off completely, not completely, but I think we're 75% roughly around here. Then we went off and added 15 back around 40, 50. But we want to participate in this uptrend. So the next one coming up is early September. I introduced this last webinar. And the more work I did into this, the more I found out this is going to be a pretty major one. The next major one I had is late September, early October, but I'm putting this early September one into the important category. And you'll see as we go along this webinar, but one piece I'll show you is, let me do this real quick. This is the NASDAQ 100. This is just my Gann analysis on it. Here's your 45-degree line. You can see how it's bottled up all these, the first bear bounce. We're moving up into it right now. Right now, we're trending above along this 1x2 line, which is acting as resistance a little bit. So we have some pretty heavy resistance overhead. But whenever you see these lines cross like this, these important lines where the price is reacting to, it typically acts as an inflection point. And this is coming up in late August. And we have actually two, I think I removed one of them, but there's actually two important time factors for the NASDAQ 100 coming together in early September. It's the first week of September. So we have the NASDAQ actually lining up with what we identified last week. So I think we'll be on guard for how we're trending into this level. Let's say we get a fourth wave and that fifth wave up, then we know that we're topping out in either the A wave or the first wave of that leading diagonal. So this is the date to mark, is late August and early September, pretty tight window too. So that's the next one up. Regarding our hedge signal, we're still in bear market mode, this blue shade. And what that means is we ignored the standard signals, which are all flashing green right now. And we look at the bear market signal only. In bear markets, we've had these scenarios back in 2008, especially where everything, price was trending up in a corrective pattern. All the signals were flashing green, but the bear market signal was giving us a warning. That's still happening right now. What we're looking for, you see this green line? we want it to have a smooth move above this blue line right here, and that typically signals liquidity is returning in a meaningful way. What's happening is we're not getting that. We're getting this overlapping chop, which is somewhat of a warning. So, we're factoring that into our decisions as well. And just wanted to let y'all know about that.